Are you a short-term rental investor and you're interested in tax planning and asset protection for your short-term rentals, especially in light of the big, beautiful tax bill that was recently passed? Well, I was just interviewed by Derek Jones of Hospitable, one of the premier websites when it comes to managing your short-term rentals. And I thought what I would do here with this video is play that interview for you. All right, let's get started.
My name's Derek Jones, and I'm super thrilled to have Clint Coons from Anderson Business Advisors with us today. It's kind of like a little celebrity moment for me because I've been watching his YouTube videos for like a decade. I have also been a customer of Anderson Business Advisors from the second short-term rental property that I had because I did everything wrong on the first one. I did not have my entity set up correctly, did not have bank accounts set up correctly, did not have a management company, all the things we're going to talk about today. After catching Clint and his team's content, it was clear that they know what they're doing and they're very generous with their content. And so honestly, I'm very thrilled to have Clint here today. I also work full-time for Hospitable, which is a property management software for short-term rentals. And so I work for Hospitable full-time while managing my short-term rentals. So I am in this exact space for the content today of how do you do both and how do you get the advantages and how do you make sure that you're doing this kind of clean. So with that, I'm going to turn it over to Clint.
My name is Clint Coons with Anderson Business Advisors, and if you are interested in investing in real estate and protecting those assets and reducing your taxes, Anderson is the firm for you. I started the firm back in '99 with my partner Toby Mathis, and we built it upon the premise that putting together legal and tax is so important for real estate investors because a lot of investors struggle. They may get the tax side down, but they don't have the asset protection or vice versa. And so what we do here at Anderson is we work with investors all over the country, showing them how to create the proper structures to capitalize on the numerous tax benefits that are available to real estate investors while protecting their investments along the way. As an avid real estate investor with over 200 properties, I know how important this can be, and so it's a real pleasure to be here and share this information. Having worked with clients who have built portfolios and lost them, having worked with clients that have been overpaying in taxes for years because their CPA did not understand the benefits of real estate, it's showing me that by delivering this type of information, you can help out a lot of people. All right, Derek, hey, let's start talking about short-term rentals.
Sounds great. All right. Clint, when you and Anderson Business Advisors support all types of real estate investors, but when you hear short-term rentals as part of a portfolio for any real estate investor, what comes to mind when you hear short-term rentals?
Well, typically what comes to mind is someone who needs to reduce their taxes in the recent environment because of the advantages that come from short-term rentals, but also those individuals who are looking to increase cash flow from their rental properties. Because as you know, there's so many different markets out there, and it's really hard to get the type of cap rate you're looking for with a traditional rental because prices have gone up. And so what I've seen with a lot of our clients here at Anderson is that many of them, for the reasons I stated, taxes number one, and we'll get into that, but also just to increase their cap rate, their return on their investment, have looked at short-term rentals as a way to do that because the numbers just work out so much better if you buy in the right areas.
Yeah, it totally makes sense. I know the industry calls it sort of your buy box, right? Like how much are you willing to spend? And I think with short-term rentals, it can really expand the buy box and maybe make your offers a bit more competitive in a day where prices are up. So, Clint, your firm and your firm, Anderson Business Advisors, really preach these concepts of asset protection and anonymity. For those who are not familiar with those terms, what do those really mean for a real estate investor? And let's say those who are investing in short-term rentals, they either own those properties themselves or maybe they're managing them on behalf of someone else.
Yeah, so when it comes to asset protection and anonymity, what we teach and what we put into practice as well, even with my own investing, is that I want to ensure that if anything were to go wrong with one of those properties, for example, about 2 months ago, a large tree fell through one of our properties. And if it couldn't get any worse, a month later, one of them burned to the ground completely. So when you're in situations like this, when you own real estate, there are things that are going to happen. And if you are the owner of title, that means your name is listed on that deed as the person that owns the property, then you're an open book. If anyone is injured in any of the instances that I just shared with you, then those injured parties will sue the owner of the property. And this is something that comes up a lot with real estate investors, that they don't appreciate the risk many times, because it's, hey, I haven't been sued yet, so therefore, do I really need protection? I'm just going to load up on insurance and carry a $750,000 policy, and that's going to cover me, until that mistake happens with your property and somebody's injured and they sue you for something that's not covered under your policy. Maybe it's toxic mold, or think about it in the reverse, because we always focus in on the asset creating the liability. But how often do people sit there and say, I'm a risk to my assets because I'm out there driving. I have kids that are driving. I enter into agreements every day. When I'm doing stuff, I'm generating liability personally. And if I were to find myself involved in litigation, then that results in putting my assets at risk. So it's a two-way street. And when we think about putting our properties or protecting our properties, what we want to do is make sure that we're protected from the liabilities associated with the assets, and that my assets are protected from the liabilities that I bring to the table. And so LLCs are an important component of that. And then on top of that, we like to layer an anonymity structure like you raised, because at the end of the day, I've seen this so many times. There are attorneys who are motivated by recovery, and the greater the recovery, the greater the motivation to bring a case. All right, so how do we then fight that, or put up a shield to protect someone from looking at your assets and saying, hey, Derek is the one that I want to go after because Derek has a lot of property. So Derek is going to be willing to settle this claim out because he doesn't want to risk losing his assets. Or I can just make Derek's life so miserable, he'll stroke me a check. So what we like to do is structure our investments, or our entities that hold these investments, in a manner in which, if you look at the LLC, your name's not titled on it. And so many people that we work with that come to our events, and I show them this website. It's opencorporates.com. You can go to that website. You just type your name in the state in which you reside in. If you have set up an LLC or a corporation, limited partnership, whatever it is, it'll tell us. It'll tell us where you live, what entities you have. I can search you nationwide. And it's just amazing how many people are shocked to find all their personal information out there. And that, for me, as an attorney, if I was a litigator or a personal injury attorney, I mean, right there, that's a pot of gold for me.
Well, it's a great point, and especially referencing those short-term rental operators who own their properties. But Clint, would you agree or have any comment on, we also have a lot of our customers at Hospitable who do what's called co-hosting. They're managing someone else's property. But I often see that those who own that property still have title in their own name. They don't have any anonymity. So something that I recommend, and would love your comments on this, Clint, is if you are a co-host, you could recommend this type of structure to your owner of the property. They may not know any better, and it can be an extra value proposition that you as the co-host could offer to that owner to build a little bit of trust, but also to protect your owner as well.
Sure, and as a co-host, I mean, how are you protecting yourself? Are you serving as a co-host in your individual name, or have you thought about that, hey, as a co-host, if something were to happen with the property, I can guarantee it, you're going to get named. There was a case out of Florida for $18 million because fentanyl was discovered, unfortunately, by a toddler that was, the parents, they rented this place, they thought it'd be fine, and the toddler's crawling around, finds some fentanyl, ingests it, and dies. And so who do they name? They name everyone that was involved with that rental. And that's a situation where you don't have enough insurance, and also it's not preventable. I mean, there's no way you could stop or go in, unless you brought in a hazmat team, and thoroughly cleaned a property, okay, to avoid someone from finding a small piece of fentanyl laying on the floor under a dresser or something like that. So, yeah, everyone needs the protection.
Yeah, and in 11 years of hosting myself here in the Atlanta, Georgia market, the things you would never think that maybe you would come into contact as a short-term rental operator, but I've seen not all of them, but I've had weapons left at the property. I've had marital and children disputes happen where they've tried to pull me in. I've had people drive over the driveway and sort of curb their car. There's kinds of things that pop up all the time that I think just might be more prone to short-term rentals, where asset protection and anonymity just seems to be like it should be a standard for all operators.
Sure. I mean, just think if you rent your property out, maybe it's a bachelor party, you're not aware of that, and the guys start trashing it, and they bring in some entertainment, and that gets out of control, and the next thing you know, they're drunk and they're damaging the property next door. And so that person that lives in that next door property, they're going to sue for damages, and they're going to sue you. So those are things that we have to focus on as well. It's just not your house or your people that are renting from you, but it's also your neighbors who can bring claims. We had a client in Hawaii. Unfortunately, it was a meth lab. They didn't realize it. They were running it down in the basement, caught on fire, burned to the ground. And their greatest source of liability came from two things: the neighbors' homes, which were substantially impacted by the heat from this fire, basically melted these homes, and then the environmental cleanup. So those are things that no amount of insurance is going to protect you.
Yeah, great. Okay, so what I've done here is I've compiled 10 questions that Hospitable customers have asked to ask the experts at Anderson, who is Clint. So we'll start off with the first one. This is a question from one of our hosts. I have a W-2 job and manage my own owned property. So they own their property, but they run the short-term rental business on the side. What tax benefits are available to offset my W-2 income?
Well, that's just it. Okay, so when you run a short-term rental, there's some rules here. It gets a little complicated, but I'm going to make it as simple as possible. If your average rental period is 7 days or less for the entire year, you just add up how many rentals you've had, divide it by how many days the property was rented, and as long as that number is 7 or less, you're 50% to where you need to be for what I'm about to share with you. Okay, so let's first figure that out. Now, after you've figured that out, if it's 7 days or less, then we have to look at how much time have you spent on that property. All right, so if you have spent at least 100 hours managing your property, and you're the owner of that property, working on that property, and that 100 hours is more than anyone else, and we can go back to this and talk about how you do that when you have cleaners coming in and taking care of your property. So as long as you can show 7 days or less, and I've spent 100 hours managing my property, and those hours are more than any other one person, then you open up this possibility. And that is the ability to depreciate that property and take that depreciation deduction and use it not only to offset your short-term rental income, but also to offset your W-2 income. Because you've met the IRS tests in order to be seen as, I'm going to say business, but it's technically not a business, but essentially that you've met the material participation standard to make it deductible against your W-2. And that is what so many people refer to as the short-term rental loophole. And it's one of those benefits that we've been using for our client base to really drive down their taxes.
Okay, that is huge. Let's break down some numbers for that. So let's give an example for this. So if let's say I'm 150K W-2 worker, I have a full-time employer, I run this short-term rental on the side, but I bought a $500,000 property. Can you walk me through, approximately how much of an actual tax break could I get off my 150K W-2 income?
So the way it works, and I'll tell you an example. So for one of my properties, here's what I did. I bought the property and I put it into service. That means you have to start renting it out. All right. So now this is what happens a lot of times when we're talking about short-term rental. Sometimes you're going to buy property and then you're going to rehab the property. So I'm going to get into your numbers, but I want people to catch on to this because this I think is really important. You see, in order to get the deduction I'm going to share with you, you have to put that property into service. And what that means is that when you acquire the property, you have to start renting it out, okay? So you bring in someone, you get that person into the property and you start renting it out. And it could be just for a short period of time. It could be you just rent it for 7 days. You've now satisfied that test, so it's in service. So once it's in service, then you're able to enact this strategy right here. And the strategy I'm referring to is a cost segregation study. And what that means is that you're going to hire someone or engage with someone who is going to look at your house and tell you, hey, there's components to this property that are not going to last 27 and a half years, which is the standard depreciation rate that most people apply when they own investment real estate. In fact, you're forced to do this by the Internal Revenue Code. So what they're going to say is, hey, there's things here that are 5, 7, or 15-year property, meaning that their useful life, after 5 years, it's junk, right? It's not worth anything anymore. So when I bought this property 3 years ago, put it into service, and then I engaged with a cost segregation study specialist. And what they essentially did is they called me up and they said, or we set up a time in which they would evaluate my property. Now, they didn't physically come out to the property. What we did was use my iPhone and we FaceTimed, essentially. And so I went out to my property and I said, I'm here, great, show me your property. And so they told me where to walk. And so they looked at the landscaping, they looked at the garage, the interior of the garage, they looked at the roof. We went into the house, they looked at all the closets, the bedrooms, the kitchen, the bathroom, the heat pump, water heater, you name it, carpeting, flooring. And after they were just making notations, all this information. And then they produced a study. And that study outlined how much of that asset's overall structure falls into that 5, 7, or 15-year category, meaning that the light fixtures are only going to last, I don't forget what it is, 7 years, for example. The carpet's only good, the flooring, current flooring, it's only good for 5 years. The landscaping's good for 5 years. And they put all this together, and then they said, all right, so what that means is that you're able to depreciate them on an accelerated basis. You don't depreciate them for 27 and a half years, where a lot of people take the value of the structure divided by 27.5. And this is the mistake so many CPAs and tax preparers are making for their clients that own rental real estate, especially short-term real estate. They don't understand this concept. They just use the straight line depreciation. Whereas what I was doing and what we do for our clients is we show them, no. Let's get this depreciation accelerated, which means you get more deductions right away. So you're able to take the useful life and use it up. And so those deductions become valuable to us because we can use them against our rental income, or we can use them against our W-2 income if we meet that test that I laid out for you. But then comes the Tax and Jobs Cut Act, which has been extended here. And what they did in the Tax and Jobs Cut Act, they said, hey, if you accelerate your depreciation, not only do you get to accelerate it, you get to bonus it. And this is the secret sauce for short-term rental investors that they have to be taking advantage of if they really want to maximize the return on their investment. Because on that property I just shared with you, they produced the study. They said, here's 5, here's 7, here's 15-year property, and it amounts to, say, $65,000. Then because we have bonus depreciation, rather than taking it and deducting it over 5, 7, or 15 years, you can deduct it all in year one. And so in year one, I got a $65,000 tax deduction that I could then use to offset my other income. And so for a short-term rental owner, if you 7 days or less, 100 hours more than anyone else, you can then take that $65,000 deduction and apply it against your $150,000 W-2 income. And so that's where this becomes so important. Now, what I want the listeners to understand about this strategy is that I run into people all the time, short-term rental investors, who tell me, oh, this is great. You know, Clint, I watched one of your videos like this and I saved $70,000 or I saved $40,000 by following that strategy. And I'm like, okay, well, tell me about what you did. Well, I bought this property, I had it in service, and I ran that study, and I got all this deduction from it. And I'll ask them, well, did you rehab the property? Oh, yeah, we rehabbed the property. I said, well, okay, well, did you do 2 studies? Well, why would I do 2 studies? I got so much benefit here. I can't do another study. I've already done one. And that's the mistake that a lot of investors make here. And this is the trick. So if you're going to buy a short-term rental and you're going to rehab that property, then you must do this or you're going to throw away a ton of deductions. What am I referring to? Put it into service, just like I said, rent out for 7 days, get it into service, then take it off the market, and then figure out what you're going to rehab. That means what are you going to replace? Maybe you're replacing the kitchens and the bathrooms. Do a cost seg study on the property as is, okay, with everything there, right away, then come in and do your remodel, then go back in and do a second cost seg study. And what you're going to be able to do then is double up on that. So it'll take you maybe from $60,000 now, which most people are doing, they're happy with that. I'm not happy with that. I'm like, you lost $30,000 because you didn't do the second study that you're supposed to do. Get the first one done before the rehab and then do the second one after the rehab. Most people do this only one after the rehab. And so that is a lost opportunity that can put more cash back in your pocket.
And so in that is very timely for me. I just bought a couple properties that are old. They have long-term tenants. I want to make them a short-term. So I'm learning here as well. Can you break that concept down? Why would that be? Is it because it's new carpet, new HVAC, or is it just because it's a second study? Or why do you get to double up on the benefit if it's still the same house and the same footprint, whether you did the first cost seg or the second, or before or after the renovation?
Yeah. So let's just take your carpet example. So we do the first cost seg study, and you've got this carpet, and we realize, hey, this is 5-year property here. Therefore, we get a deduction for that, right? The existing carpet. Now you rip it out, and you put something new in, right? Well, that carpet hasn't changed. You put in new carpet. Well, that carpet's only going to be worth around for 5 years, so you get to do another cost seg study on that. They call this a depletion allowance, that is what they're doing. With the value of the asset that you're removing, okay, it still has a useful life. So when you rip out that carpet, it still had a useful life left on it. And so what they're going to tell you is that you can still get a deduction for that useful life because you haven't got the opportunity to depreciate it all yet. So they allow you to pick that up for everything that you're replacing in that property. So if it's a bathroom, if it's a kitchen, if it's a roof, always do the study to pick up the depletion allowance on those components that you're removing from the property to make sure that you get that benefit. Even though you're throwing them away, you still get the benefit.
Amazing. So this is the hot tip for the entire real estate industry, I think, at this point. There's all these calculators for rehab cost calculations. Put a row in for cost seg before and after. It just needs to be part of the standard renovation punch list. But make sure you don't just do one, that you do one first and then you do one afterwards. It's an awesome hot tip, Clint.
Yeah, I always tell people that, when it comes to using this strategy, you can actually get into properties now, and maybe your down payment to get into something is you have to put $80,000 down. Well, factor in the tax deduction you're going to receive by doing the cost seg with the bonus depreciation, and you're not $80,000 out of pocket. At the end of the day, when you bring that tax deduction back into play here, maybe you're only $20,000 out of pocket. So basically, the IRS partnered with you to buy that property by giving you this massive benefit.
So, okay, and the bottom line here, say I bought a property for, I'll go up to a whole number, $1 million. Let's say you live in California. Maybe your short-term rental is $1 million. I do a cost seg. I understand that I can get a deduction on my W-2, that it's bonus, that it's accelerated. Approximately what percent of that purchase price could I expect on year one because of the bonus depreciation?
Well, it's going to range based upon the type of property, but it can be anywhere between 20%, 30% on that property. So it's a sizable number.
The example we just get, if you are $150K W-2 annual earner, you bought a property for $1 million. Let's say on the low end, you get 20% of that as a deduction. That sounds like a full offset of your W-2 income.
Sounds like a great tax strategy to me that you're missing out on.
Okay, so if you're a real estate agent, if you're an investor, this is why we want to bring this concept. Don't lose a great deal or a short-term rental over a $5,000 or some small amount of purchase price. If you're only looking at the cash flow and appreciation, there's this third leg of a benefit to the real estate, which is the cost seg, that could totally blow your calculations out of the water, especially if you have a W-2. I know for myself, in some cases, I have bought short-term rentals that I think will break even or maybe might lose a little bit, but I need that depreciation on my W-2, so I go ahead and purchase it because I know that there is this strategy in place. So certainly we would prefer to have all three. We want appreciation, we want cash flow, debt pay down, but also the tax benefit here is one that we want to make sure people consider. Okay, so cost segregation and bonus depreciation is huge, but we also we're going to hopefully apply that to our W-2 income. We want to make sure that's clean for our CPAs and our accountants. So I'm hoping, Clint, you can give us an overview for what is the best entity structure for those who own their properties to hold those properties in, such that we can start to execute on this plan.
Okay, so this is the thing. Holding assets, real estate assets, it's not a one-size-fits-all approach. It really depends on where the asset is located. And a lot of people miss this concept and they think, well, all I'm going to do is I'm just going to set up a limited liability company and dump my property into it, and everything's going to be fine. So what I like to look at, what we always look at, is where's the property located, because that's going to drive the proposed structure. So it's where it's located, when did you acquire it, what is the interest rate on the property, who owns the loan, okay? And then we want to know whether or not there's a transfer tax to move the property into the entity, or is there a reassessment that can take place if you move property into an entity. So to solve for these issues, what we typically will do for a client, if we're analyzing something, is, well, the first step will be, hey, let's set up a limited liability company in the state where the asset is located. Let's say I own property in Texas. I would set up a Texas LLC, but that Texas LLC would be owned 100% by a Wyoming limited liability company. As we talked about earlier, the anonymity of owning a asset or an entity without someone knowing that I am the actual member or manager of that company starts with having a Wyoming base entity. So I create a Wyoming LLC, and the benefit of this is my name is not on that entity. That means Wyoming does not collect information on who are the members or managers, so it's not publicly available. So let's say I set up Pickles LLC in Wyoming. Now when I go to set up my Lone Star LLC in Texas, when I file for that, Texas wants to know, hey, who owns this entity? I'm going to say Pickles owns the entity, and Pickles is in Wyoming. And so when Lone Star gets filed, if someone looks up Lone Star, it's going to point to Pickles. So I get this structure done. Now, if I had 5 properties in Texas, then I would have 5 separate Texas LLCs set up, ready to go, all owned by Pickles. And so not one of my tenants would ever be able to associate that LLC that owns the property back to me, because it all points to the Pickles. And vice versa, if someone looks at my name up, they'll never see that I own Pickles, and therefore they wouldn't know I own these Texas limited liability companies. Anonymity is your first line of defense. All right, so that's how we begin the structuring. Now, in putting the structure together, what we're looking at then with the asset itself is, all right, I use Texas. This is a great one because Texas doesn't have a transfer tax. So I can move property directly into a limited liability company, and it won't be reassessed, and they won't hit me with a tax. You tried to do that in Florida, you're going to get hit with a tax and a reassessment on that deal. So that's a problem. So the next thing I'm going to look at is the mortgage. Okay, so if you have a mortgage on your short-term rental, before we transfer it in the LLC, I want to know How long have you had that mortgage and who owns it? Because this is key here. When you transfer property, or when you obtain a loan, let's talk about that first. When you obtain a loan to buy investment real estate, most of those loans that you're acquiring, unless it's a portfolio lender like a community bank, they're holding them to be sold to Freddie or Fannie. And in order to sell that loan to Freddie or Fannie, they have very specific guidelines, right? Namely, if it's residential real estate, 4 units or less, it has to be owned by an individual. Okay, so they're going to follow Freddie Fannie guidelines to make sure that they're going to buy the property. So you have to close in your own name. You're not closing in the LLC. Now, Freddie or Fannie, or that loan that you have, and now, like all loans, they have what is called an acceleration clause, which means that if you transfer title to that property to a third party or to an entity, the lender reserves the right to call the note due. And that really comes down to, hey, I don't know who the owner is, I don't know about their ability to repay, and therefore there's new risk involved, and so we have to do a new loan on that property and refi it under the new owner's name. Well, transferring it into your LLC could trigger that if the broker still holds your mortgage. But when they sell the property to Freddie or Fannie, not the property but the loan, then Freddie or Fannie, when they own it, they have their own guidelines that they operate under that permits you to transfer your property into an LLC, and they won't accelerate. Whereas the broker that originally underwrote the loan does not allow that. So why don't they allow it? Because in order to sell it to Freddie or Fannie, they have to have your name on it, right? Freddie or Fannie will not buy it if it's in an LLC name, even though they allow it to be held in an LLC. It's crazy town. So what I'm going to do then is I'm going to look at another website. We're going to go to Fannie Loan Lookup Tool and then Freddie Loan Lookup Tool. You just Google them. And you put in your property address, your name, your social security number. It tells you whether or not they own them. If they own them, I'm like, oh, no problem. Transfer it right into the LLC. If they don't own them, then what I'm going to do is I'm going to use an entity we refer to as a land trust. And so what a land trust is, it's a revocable grantor trust. And that's how I tell every client, if you're ever asked, after we've placed your property into a trust, if you're asked by a lender, if you're asked by a insurer, if you're asked by a title holding company, what type of trust is this? You don't call it a land trust, you just call it a revocable grantor trust. That gets around the original underwriter's rules about not transferring property into an LLC. We can put it into a land trust or a revocable grantor trust. That's permissible. So when I put it into this trust, what's notable is the trust is owned by the LLC. Because see, a trust by itself doesn't offer asset protection, except in Florida. So in Texas, what we'll do is we'll create a Texas land trust, put the property into the Texas land trust, and then we put the trust into the LLC. And you're probably going, wow, it seems like there's a lot of entities. This is going to get complicated. It appears that way, but it's really not. Because what happens is that everything I just described to you, you're not filing any tax returns for them. You're running the asset just like you normally would. But from the asset protection standpoint, if something were to go wrong with the property, you have the shield of the LLC to protect you.
Excellent. So it seems that there's components coming together here. There's an LLC for a property. There's a land trust, which you've also described. You then mentioned this Wyoming entity. Is that synonymous with a holding company, or what is the role of a holding company if it's not?
Yeah, that's what I would call a holding company, because its sole purpose is to own each of your property holding LLCs. So it holds those. So it aggregates all the ownership interests down to one LLC. You know, in my example, my business partner and I, we have over 200 properties, multiple asset classes, and our ownership gets aggregated down to one limited liability company. And the reason we do that is because I don't want to have, 200 LLC K1s on my tax return. That'd be a nightmare. I'd have to file multiple tax returns. So what we did is we set up a holding company in Wyoming. It owns all of our LLCs, so it provides us the anonymity, and then it ensures that each of those LLCs, they don't file tax returns. The only one that files the tax return is the holding company.
Got it.
And I want that, especially this is an important aspect of what we're talking about here. You know, the benefit of having a holding company is you set it up to file a tax return. You treat it as a partnership for federal tax purposes. And the reason why I like to do that, I mean, our tax department, you know, we have over 160 employees in our tax department. And we do close to 15,000 returns a year, business and personal returns. And one thing is evidently clear if you talk to these professionals that work in that department. When you run your income, your real estate income, through a holding company treated as a partnership, you get two main benefits. Number one, you reduce your risk of audit. And that's really critical for these cost seg studies because, tell you what, if you carry that on your 1040, all these properties directly in your name, and your returns being looked at by an auditor or representative of the IRS that they just hired, they don't understand real estate investing because they're not that sophisticated yet. They see that and they go, this isn't right. You can't take that type of deduction. That's just not right. That's unfair. And they'll flag your return for audit. But when you run it through a business return, you only have experienced individuals looking at those returns. And they see that stuff all the time. And they know what looks right and what looks wrong. So they don't have that same confusion. So you reduce your audit risk. But more importantly, you increase your borrowing ability as well. Because how real estate income hits your 1040 can either help or hurt you when it comes to applying for your next deal or qualifying for your next deal with a loan. And that's something I learned the hard way when I started my investing career by keeping everything in my own through disregarded entities. And it made my ability to borrow, it shrunk it by 25% just because of underwriting guidelines. So you need to think about that when you're setting structures up.
It's an incredible point. I know the IRS has they have two things. One, on their public-facing website, you can actually go. They will tell you the percent likelihood of being audited based on certain characteristics. And when you take a look at just when things are run through your personal name, you see those are all very high percentages. And if you have certain attributes to your return, as soon as you start clicking over to the business side, the chances or the percent that you might actually get audited definitely goes down. So those are public data. You can see that to support Clint's claim. And also what might be worse than an inexperienced IRS agent is AI now, which the IRS has indicated with their employee cuts, that they are applying AI to review returns to find discrepancies. And so it all the more reason to make sure that you are doing this the correct way.
Yeah, like they did in California recently with the bar exam. There's some talk that they had AI create it, but that aside, they had AI grade it. And now I believe there's some lawsuits stemming from that because so many people failed the bar exam in California this last go around. And they're saying it's because of the AI not understanding the nature of the questions.
Yeah, what a world we're in. Okay, so we've got these pieces coming together. We've got LLCs, we've got a land trust, which I think you mentioned a land trust can be used even if you have a loan. So if you don't own the property outright, if you own the property outright, of course you could put it in whatever entity you want with an LLC. We've got a management company, which is often a Wyoming LLC or a Wyoming holding company for that reason. What about a management entity? So these short-term rental operators, they're responding to guests, they are dispatching cleaners, they are handling the operations of the business. What's the role of a management entity for these operators, and how would that play into this overall structure?
Well, the role of the management entity is one, to insulate you from liability that could occur with the property. And the second reason why we do it is for tax savings, because cost segregation is great and you can take that deduction, but how about charging a management fee to your own entities to pull income out of your tax bracket and put it into a different tax bracket? Meaning that when I create my management entities for our investor clients, we typically look at setting up a LLC as a C corporation for federal tax purposes. And we do that because we don't want anything flowing down onto their 1040, because a C corporation is a standalone taxpayer. And immediately when you throw that term out, investors, their brains will associate C corporation with double taxation, because that has been told so many times to people that if you set up a C Corp, you have to deal with double taxation. Okay, if you set up a C Corp and you don't know how to spend the money for your benefit, yes, you're going to deal with double taxation at some point in the game. But if you expense everything out, then double taxation is never going to be an issue. And so what do I mean by that? Well, what we're doing here is we're charging our LLCs that hold our short-term rentals, we're charging it a monthly management fee. I mean, to manage that LLC, to do everything I'm doing, I'm going to take a 10 or 15% cut. So that then reduces my taxable income that flows down through my holding company that hits eventually my 1040. And if you're doing it right, it could actually create a scenario where that management fee was a good portion, if not all, of your profit. And so now you just eliminated any profit on that rental. And so now all you're showing is losses, which you're then taking those losses like we described against your W-2 income, and all the profits now up in the C corporation. So it's sitting up there in your management entity. So what are you doing with that management entity and that income that's hitting there? You're spending it in a way that is tax deductible to you or to the company, but it's not taxable to you. And there's a whole host of strategies that our clients will utilize. And you've probably heard, some of the most common strategies. Number one, of course, is going to be the Augusta rule, Section 280A, renting your personal residence to your business to hold business meetings. If you can do that up to 14 days a year, it's non-taxable. And we have a lot of clients. We started teaching this strategy back in 2001. That's how long we've been doing this strategy. Before anyone else even was talking about it, we were utilizing this strategy. And we've been audited on it, and we know how to ensure that if you do get audited, it can withstand an audit. And there's a lot of people out there that talk about it, but they don't know how to paper it the right way to make this work. But what ends up happening, let's say that the rental value of my home, I'm having a business meeting there to talk about my spouse to go over our short-term rental portfolio and some changes maybe we're going to make, evaluating platforms. Then the money you're paying yourself to rent your house from your corporation or to your corporation is tax-free to you. So, we have clients that will generally pick up between $15,000 to $25,000 a year in tax-free cash out of their business, and that's all deductible to their business. And so strategies like that, I think, are something that you'd want to focus on. So do you do this immediately? No. If you have one short-term rental, that strategy is not for you, okay? If you want to manage your property with some protection, just set up a LLC that's disregarded for tax purposes and run your management through there. But as your portfolio starts to grow, maybe you're up to 4 or 5 properties, then it's the right time to look at this strategy here of using a management entity treated as a C Corp. And I don't want to leave anybody that's watching this and think, oh, I need to go out and set one up to manage my one property. You'll never get any benefit out of it. There's just not enough income there to make that strategy work.
Got it. So you mentioned charging a management fee out of the management or entity. What other expenses can go in? I mean, can you put cell phone bills? Can you put travel? Are there other
Travel,
expenses?
Cell phone, internet, your vehicle, mileage deduction you can run through there to drive around looking at assets. I mean, I'll give you a perfect example of this. So we used to spend 3 weeks in Hawaii when our kids were little. We did this for about 10 years. We'd go to Maui. And I would go there, and the first thing I would do before we even got to the condo that we would stay in is I'd stop by this place called Hula Hogs in Kihei, and I would rent a Fat Boy. And I'd rent this Fat Boy, and I'd always get bags on it. I was very particular. I'd call the guy up and say, hey, make sure he knew which one I liked. And I said, it has to have bags. Because I would cruise around looking at properties to buy. And so I would deduct that. We had a van. The van, kids and everything, we'd use that for the family. But when I was there, I'd go around looking at properties. And the reason I had bags is to sell the flyers. I'd put in the bags, the date and time, and put all that on there. And so that was a deduction for me. So these are the things that you look at. Whatever you're doing that you can tie back to your business can be a deduction. I often say, when in doubt, deduct. All right, is a strategy that I like to employ.
All right, excellent. Okay, so all those components come together. You have an LLC for a property or a land trust. You have a Wyoming entity, which is a holding company. Then you have a management company. Bring all these together is obviously something Anderson can help anyone do. Um, let's say that all that is set up well. These short-term operators are just spinning off cash. So now they might take a distribution. They want to live life, or if they have a lot of free cash flow. And let's say that operator now has tens of thousands, maybe 100,000 or more in cash that is sitting, that maybe they took a distribution and could be sitting in a personal bank account. How do you advise them to think about protecting their personal assets at this point now that they have executed the strategy and they're flush on cash?
That would be a second Wyoming limited liability company. And what I do with that is I just set it up to hold cash and investments. So before we got on the call today, one of the things that I also do in investing in real estate, I'm also a private lender. And currently I'm lending to a developer. And this weekend he said, hey, I need another draw against the loan. So he says, hey, I need $500,000. Okay, so what I did is I logged into my Chase account where I have a money market account set up in there, and I traded $500,000 of that, converted it to cash. Right? So now that cash is there to be wired to this developer for his project. That is all held in the name of a Wyoming limited liability company. So whenever I receive money from the rental side that comes down to my personal account, I immediately put it up into the safe holding LLC, as I refer to it. So all my savings, all my cash, all my brokerage accounts, private loans, all that sits in that one LLC. And when I need funds, say for personal use, to make another investment, then I draw those out. Now, the mistake that a lot of people make, and I get this all the time when I'm teaching events, they say, well, that's taxable. What's taxable? Well, you pulled money out of that LLC, so that's taxable event to you. It's not taxable to me when I take money out, nor when I put money in. My tax liability comes at the end of the year when I look at that LLC and I said, did it have positive income? So where does it have positive income? From my investments. Then that income that LLC has generated, that is taxable to me. Moving money in and out, unless it's set up as a corporation for tax purposes, is not taxable.
Okay, so kind of to boil that down a little bit, if a short-term rental operator, they have a personal bank account in which they're putting all the proceeds, you would suggest that they have a second Wyoming entity and have the bank account in that entity to store that cash. And then does that mean if a creditor comes or they potentially get sued or that they cannot come after, or makes it more difficult to come after that cash?
So what happens here is that, what am I protecting against? With real estate, it's a dangerous asset is the way we refer to it, meaning that it creates liability on its own. You don't have to do anything and it can burn down and you can be sued. Your cash doesn't create liability for you, right? No one's going to get hurt because you have an investment in treasuries.
Okay, they have personal cash now sitting as a benefit that they've been running a good operation. How do they protect it? And then, like, if they do put it in that Wyoming entity, does it make it harder for someone to sue them if it's sitting in there, or why would they do that?
So the reason why they put it inside of a Wyoming LLC, or I put mine in the Wyoming LLC, is so that if I get sued personally, then that cash is protected. See, if I just left it in my savings account or my checking account, then it would be exposed to a creditor, all right, a personal creditor. And so, great, I've protected my real estate, so I'm protected from that, but the cash I'm generating off the real estate, I've done nothing to protect that. And I run into investors all the time. They sit in this huge pile of cash that they're going to use to reinvest, or they put it in the market while they're waiting to find another property, and it's all in their name. And I explain to them, you have other liabilities other than the property, right? And if something were to jump the property because they say, oh, well, you were personally managing this, you were negligent, and they name you in a lawsuit, you just made that cash available to a plaintiff, all right? Meaning that they could file a prejudgment writ on that and freeze your cash. And I've seen this happen before. And your ability to defend yourself has been greatly diminished because you don't have the funds to pay your attorney. So get the money out of your name and put it in a Wyoming LLC.
Excellent. All right, we're coming up on our time, so I've got two other questions here that are maybe more at a little bit higher of an altitude. So, uh, if a short-term rental operator executes everything that you've just said, all the entity structure for anonymity and asset protection, what mistakes do the operators make that ends up nulling or challenging that defense that they have set up, whether it's commingling funds or like other types of things? Your firm can help them get set up, but they need to still operate correctly. What are the most common mistakes you see after they get all of this set up, and how can they avoid that?
Well, the most common mistakes that we run into is moving the money the right way. So if I've set up remember a previous example where there was a Lone Star LLC owned by Pickles LLC. Lone Star LLC brings in $20,000 and they want to buy a new boat. So they just write themselves a check right out of Lone Star to themselves personally or transfer the funds and they skip Pickles as if Pickles doesn't even exist. That's a problem because you have no personal relation to that LLC that would give rise to distributing those types of funds to you. And so what you always have to do is just follow the lines is how I describe it. Is if Lone Star is owned by Pickles, you move the money from Lone Star to Pickles and then from Pickles to you. So that's the most common mistake I find is that how they move money. The second mistake is where the money's paid to. So I've seen a lot of operators, they collect the money personally, even though the property is held in an entity, and they put it in their personal checking account or their savings account. And by doing that, you're ignoring the form of the business, and so therefore, if you want to ignore it, a court's going to ignore it as well. Insuring the property. You have to make sure that the entity is listed with your insurer. Now, how you go about doing that's really important because depending on whether or not you have a loan on the property, you don't want to create any problems for the lender, so you want to make sure your name still appears on that policy and your entity appears on that policy as an additional insured. Okay, so those are the three main mistakes that I find with investors. And then the last one I guess I would leave on this topic is people tend to set up entities and then they don't renew them. Maybe you're in military and you're PCSing across the country and your mail goes to your old address. You don't update the Secretary of State. And then what occurs is the entity that you've set up goes out of compliance, it's revoked, and you don't have any protection. And so many times I tell investors, listen, that's low value stuff. Do not do that. At Anderson here, we maintain our clients' entities for them, make sure they're always up to date. Whatever needs to be filed is filed with the Secretary of State so that their entity stays strong and does not fall into that status.
Yeah, I'll plug Anderson. That is what drove me to Anderson. I thought I could set up all the structure because you guys have such amazing YouTube content. And I did. I sort of followed it. But then I went to go sell a property that was in a land trust, and I had not renewed the entity. And I had to go renew it. It complicated the closing. And at that point, I realized I needed some help with that. So it's a great value that Anderson does. Okay, last question here. You mentioned that Anderson, you handle tens of thousands of tax returns. I'm just curious if you see common traits of the really successful uh, individuals who you're filing returns for that have real estate. Uh, that's like a window into the soul of some not only wealthy but just successful, savvy real estate investors. So, is there anything else that we're missing that you could maybe share from insights from those tax returns that can help other short-term rental operators sort of think about the future of their business and also how to build wealth and protect it?
Well, I think a common mistake that we find is that a lot of people carry all their real estate on Schedule E, page 1. That's a problem. I told you how to address this earlier by setting up that holding company and treating it as a partnership. That changes where your real estate income appears on your 1040, and it makes you look better to lenders and it reduces your audit risk. So when you're thinking about your structuring, start thinking about, when I'm holding these entities, I want to run everything through a holding company that's treated as a partnership, and I'm going to get some benefits by doing it. Yes, I have to file a return, but the lower risk of audit plus the ability to look better to lenders, I think outweighs all that. So that's the first one. And the second one we really covered is that you'll see properties on returns that people have not taken advantage of a cost seg with a bonus depreciation, and they've just been missing out on tax deductions. And so when our firm will look at something like that, and we see real estate and that the client purchased post 2018, those are the questions we're going to have. Hey, have you done this yet? Oh, you haven't? Well, let's get that done and get that filed. And so that's why we like to have extensions for our real estate investor clients. There's no rush to file. Put it on extension, and so it gives us some runway now to really analyze what you have and what opportunities are there to reduce your taxable income.
That's really great insight from other investors. Clint, really appreciate all the resources, all the knowledge for short-term rental operators. Whether you follow these practices on your own, or I suggest hiring a firm like Anderson, you can see there's some big impact on taxes and some things that you can and should be doing to protect your business, to make sure your business is durable. So we hope this was helpful, and thank you to Clint and the Anderson team.
Yeah, Derek, thanks for having me on. And if somebody wants to get a free strategy session with one of our advisors here at Anderson, why don't we give them a link? Are you okay with that?
Absolutely.
All right. So then, hey guys, down below we'll put a link, and you can just click on that link, and that will take you directly into Anderson. You can schedule a free strategy session, and we can show you how to implement the strategies that I was talking about today when it comes to protecting your short-term rentals.